Here's a number that should terrify every oil bear on Wall Street: $60. That's the break-even price for the average US shale producer. Oil is trading at 65. At 50, 90% of American operators say their output will decline. OPEC is holding back supply. Iran tensions are rising. And somehow, the consensus forecast from every major bank is that oil is heading lower. Way lower. JP Morgan says 54, Goldman says 53, the EIA says 52. They're all betting on a crash. But here's what nobody's talking about. Those same analysts missed the 2021 rally, missed the 2022 surge, missed the 2024 resilience. And right now, while they're screaming bearish, oil just posted its best month since July 2023. When everyone agrees on oil direction, they're usually completely backwards. Let me show you why the bull case might be the only case that matters. My name is Alex, and I've spent the last decade tracking commodity cycles and central bank policy so you don't have to. I read OPEC reports, Federal Reserve transcripts, and geopolitical risk assessments because most people have better things to do with their evenings. And what I'm seeing right now in the oil market is one of the most asymmetric setups I've witnessed in years. If you're trying to position your portfolio for what comes next in commodities, make sure to hit that subscribe button and give this video a thumbs up if it helps you see through the noise. Before we dive in, I want to know, what's your oil price prediction by end of 2026? 70, 80, 50? Drop it in the comments. I'm genuinely curious where this audience stands because the range of forecasts right now is absolutely wild. Here's what I'm going to show you. The bull case for oil isn't just possible, it's probable. And the margin of error on the bearish consensus is so thin that even a minor disruption could send prices 30 to 40% higher. The downside is limited by geology and economics. The upside is wide open because of geopolitics and math. Let's start with where we are right now. As of January 30th, 2026, WTI crude is trading around $65.50 per barrel. That's a 4-month high. Brent is at $70.50, the highest level since September 2025. Oil is up year to date despite every major forecasting institution predicting it would crash. The bears have been consistently wrong for 4 straight weeks, and the geopolitical risk premium, which disappeared entirely in late 2025, is back in the market. Now here's what Wall Street is telling you. The Energy Information Administration forecasts Brent will average $56 per barrel in 2026, with WTI at 52. JP Morgan says 58 for Brent, 54 for WTI. Goldman Sachs says 53 for WTI. The International Energy Agency projects a surplus of roughly 4 million barrels per day in 2026. Their entire thesis rests on 3 pillars: non-OPEC supply growth, China electric vehicle adoption reducing demand, and OPEC Plus unwinding their production cuts. That's the bear case. And on paper, it sounds logical. Except paper doesn't account for reality. And reality has a way of shredding forecasts that assume everything goes according to plan. Let me show you what Wall Street is missing. Bull case number 1. Geopolitical wildcards are no longer theoretical, they're active. President Trump warned Iran directly in January 2026, make a nuclear deal or face military strikes. He said U.S. naval assets are ready to act with speed and violence if necessary. Those aren't diplomatic words, those are operational words. The Strait of Hormuz, through which roughly 20% of the world's traded oil passes every single day, is now a live risk. Any strike on Iranian infrastructure, any retaliatory closure of that strait, and you're looking at an instant supply shock that would send oil prices vertical, not gradually higher. Vertical. And Iran isn't the only wildcard. The United States arrested Nicolas Maduro in Venezuela. Whether you think that's justified or not is irrelevant to the oil market. What matters is Venezuela produces roughly 700,000 barrels per day, and political instability there creates supply disruption potential. New U.S. sanctions are tightening on Russian oil purchases. Kazakhstan is dealing with ongoing production outages. And the United States itself just experienced freeze-offs in key producing regions that reduced domestic output. These aren't hypotheticals. These are active, unfolding events. And every single one of them tightens supply or adds a risk premium to price. Now we get to the part that actually matters. Everything before this was just context. Because the real story isn't about what could go wrong geopolitically. The real story is about what's already broken structurally. Bull case number 2. OPEC Plus has discipline. They paused production increases through the first quarter of 2026. They're holding 2.2 million barrels per day of voluntary cuts in place. And Saudi Arabia, the de facto leader of OPEC, needs Brent crude at $80 or higher to balance their national budget. That's not speculation. That's publicly available fiscal data. The Saudis have a powerful financial incentive to defend prices, and they have the spare capacity to do it. OPEC Plus controls more than 5 million barrels per day of spare capacity. They can manage the market, and their track record shows they will. Every single time prices weakened in 2025, they delayed increases. They didn't flood the market, they waited. The bears assume OPEC Plus will abandon discipline and increase production into a weak market. Why would they do that? It makes no sense. They've spent 3 years building credibility as a disciplined cartel. Throwing that away to crash prices benefits nobody in OPEC. It only benefits consumers in importing nations. Bull case number 3. Supply destruction is already happening. This is the part most analysts are ignoring, and it's the part that's going to matter most. The Dallas Federal Reserve surveys U.S. shale producers every quarter. The most recent survey shows break-even prices for U.S. shale operators range from $61 to $70 per barrel. WTI is trading at $65. That's barely above break-even for the average producer. If WTI falls to $50, which is where Goldman and the EIA say it's going, 90% of U.S. operators say their production will decline, not stay flat. Decline. The Permian Basin, the largest oil-producing region in the United States, currently has 246 active drilling rigs. That's the lowest rig count since August 2021. Drilling rigs fell 15% in early 2025. The EIA itself forecasts that U.S. production will decrease in 2026 and 2027. Let that sink in. The same institution forecasting $52 oil is also forecasting declining U.S. production. You can't have both. If prices fall to $50, production collapses faster. If production collapses, prices can't stay at $50. The math doesn't work. And this isn't just a U.S. problem. This is a global problem. The oil industry has underinvested in new production for years. ESG mandates, investor pressure, and capital discipline have all reduced upstream spending. That creates a structural shortage risk in the out years. The world is consuming roughly 100 million barrels per day. If non-OPEC production declines and OPEC holds cuts, where does incremental supply come from? It doesn't. And that's when prices spike. If you've made it this far, you're already ahead of 90% of people. But don't stop now, because the next part is where the psychological dynamic flips. Because markets aren't just about supply and demand, they're about narratives, and the narrative around oil is cracking. Bull case number 4, the peak demand narrative is eroding. The International Energy Agency has been forecasting peak oil demand by 2030 for years. Their entire model assumes aggressive climate policy, rapid EV adoption, and demand destruction from efficiency gains. But those assumptions are increasingly questioned. Climate policy momentum has slowed. EV adoption in China is real, but slower than modeled. And global GDP growth could surprise to the upside, which would increase energy demand, not decrease it. China and India, the two largest emerging markets, could see demand recovery that tightens the market significantly. There's a quote I keep coming back to from a petroleum economist analysis in December 2025. The belief that climate policies will drive peak demand is eroding rapidly. That's not from an oil bull. That's from an independent analysis. When the peak demand thesis cracks, the entire bearish forecast falls apart. Because if demand doesn't peak and supply is constrained, prices go higher. A lot higher. Bull case number 5, the technical setup favors bulls. WTI formed a potential double bottom at the $54 to $55 support level. That same level held in April 2025 and December 2025. In technical analysis, a double bottom is a bullish reversal pattern. If WTI breaks above 70, and certainly if it breaks above 80, that confirms a trend reversal. And the current rally shows the market is extremely sensitive to geopolitical risk. Even minor headlines are moving prices. That tells you the market is pricing in more risk than it was 3 months ago. Risk premiums create upward pressure. Now let me tie all of this together, because when you see how these pieces connect, everything changes. The bearish consensus assumes OPEC floods the market, U.S. shale ramps production at low prices, geopolitical risks stay theoretical, and demand peaks on schedule. If even one of those assumptions breaks, the forecast is wrong. If two break, it's catastrophically wrong. And right now, all four assumptions are shaky. Here's why Wall Street gets oil wrong so consistently. They build models based on equilibrium assumptions. Supply and demand converge smoothly. Geopolitics stay calm. Producers act rationally. But oil doesn't work that way. Oil is the most geopolitical commodity on Earth. It's subject to sudden shocks, cartel behavior, and political decisions that have nothing to do with supply and demand fundamentals. Wall Street missed the 2021 to 2022 rally because they didn't price in post-pandemic demand recovery and Russian supply disruptions. They missed 2024 resilience because they assumed a recession that never came. They missed the 2014 crash because consensus was $100 oil forever, right until it wasn't. There's a pattern here. When everyone agrees on oil direction, they're usually facing the wrong way. Right now, consensus is aggressively bearish. Every major bank, every major agency, every major forecaster says oil is going lower. That should make you pause, because crowded trades break violently. And right now, the bearish oil trade is extremely crowded. The setup is asymmetric. The downside is limited by shale break-even economics. If WTI falls below 60, production starts declining, which puts a floor under prices. The upside is open. A strike on Iran sends oil to 80 or 90 overnight. OPEC extends cuts deeper, and prices rally to 75. A cold winter in Europe or a hot summer in Asia increases demand, and suddenly that 4 million barrel per day surplus the IEA is forecasting disappears. Let me give you the price scenarios as I see them. Base case, WTI trades in a $55 to $65 range for most of 2026. Range-bound, choppy, headline-driven. That's the highest probability outcome. Bullish scenario, WTI pushes toward 70 to 75 on a geopolitical shock or deeper OPEC Plus cuts. That's maybe a 30% probability. Bearish tail risk, JP Morgan has warned Brent could fall to the low 30s in an extreme oversupply scenario. That's a low probability event, maybe 10%, but it's the risk you have to acknowledge if you're positioning for higher prices. Here are the key levels to watch. For WTI, support is at $50 to $55. That's the critical floor. That's the shale break-even zone. If that breaks, you get cascading production cuts and potentially a sharp snapback rally. Resistance is at 70, then 80. A break above 80 confirms the bullish reversal. For Brent, support is 55 to 60, resistance is 75, then 85. And here are the catalysts you need to monitor week by week. Iran diplomacy or conflict, any military action spikes prices immediately. OPEC Plus decisions, will they extend the pause on increases, or will they reverse cuts? That's the single biggest known variable. US shale response, is production actually declining at current prices? Watch the weekly EIA data. China demand, are we seeing sluggish consumption or recovery? That determines whether the IEA surplus forecast is real. Dollar strength, a weaker dollar mechanically pushes oil prices higher because oil is priced in dollars. And finally, weekly EIA inventory reports. Rising inventories support the bear case. Falling inventories support the bull case. Let me address the psychological part of this, because that's what separates people who position correctly from people who chase headlines. The real magic happens in your brain when you confront uncertainty. Right now, the narrative is bearish. Every headline says oil is going lower. Your instinct is to trust consensus. Consensus feels safe. But consensus is often wrong at turning points. The crowd didn't see 2021 coming, didn't see 2022 coming, didn't see 2014 coming. Contrarian positioning isn't about being different for the sake of it. It's about recognizing when risk-reward is skewed. And right now, it's skewed bullish. The downside is capped by geology and economics. The upside is open because of geopolitics and cartel behavior. That's an asymmetric bet. You risk $10 to the downside to make 20 or 30 to the upside. Those are good odds. Here's a hard truth that might sting a little. Most people will read this, nod along, and then do nothing. They'll wait for confirmation. They'll wait for oil to hit 70 before they believe the bull case. And by then, the move is halfway over. Positioning before the consensus shifts is uncomfortable. It feels risky, but that discomfort is where returns come from. If investing felt comfortable, everyone would be rich. You're not most people. You're still here. You're thinking about this critically. That puts you ahead. So here's the bottom line. Short term, geopolitics is driving prices higher than Wall Street expected. Medium-term, supply destruction at low prices limits downside risk. Wildcards like Iran, Venezuela, and Russia could spike prices anytime. And the fact that consensus is so bearish often marks turning points. A quote from TD Securities that stuck with me: while base case may be range-bound, asymmetric upside exists if catalysts materialize. That's not a guarantee, that's a probability statement. And in markets, you don't need guarantees. You need favorable probabilities and disciplined risk management. The sources for everything I just laid out are available. EIA Short-Term Energy Outlook from January 2026. JP Morgan Global Commodities Research from January 2026. Goldman Sachs Commodities Outlook for 2026. IEA Oil Market Report from January. Real-time pricing data from Trading Economics as of January 30th. Dallas Federal Reserve Shale Break-Even Surveys. Rig Zone WTI Price Analysis from January. Daily coverage from oilprice.com. TD Securities Venezuela Analysis from January. And the Petroleum Economist 2026 Outlook from December 2025. All of it is publicly available. None of this is secret. It's just synthesis that most people don't have time to do. 10 years from now, you'll look back at this moment and realize this was when the consensus was meavily bearish, and that was the signal, not the noise. The signal. Before I let you go, I want to know, what financial topic is affecting your life right now that you can't find a straight answer on? Commodities, the Fed, inflation, housing, whatever. Drop it in the comments. That's what this channel is for. I dig into the topics that matter to you, not what gets clicks. Your future self is counting on you to see what others miss. The number that should scare every oil bear isn't $60. It's the number of assumptions that have to go perfectly right for $52 oil to happen. And in commodities, nothing ever goes perfectly right.